Imagine this. You've spent years building a dividend portfolio. You're counting on those steady payouts to fund your dreams. And then the market crashes. Stocks plummet. Companies slash dividends. Your income dries up. Suddenly, your financial safety net feels like it's unraveling. But what if I told you there's a way to protect your dividends, even when the market is in free fall? To not just survive a bear market, but thrive in it. Today, we're diving into the ultimate bear market playbook. You'll learn how to safeguard your income, spot recession-proof stocks, and turn panic into opportunity. And stick around, because I'll reveal the one sector that's historically outperformed during every major crash. Let's get started. What's your biggest fear about a bear market? Let me know in the comments below. First, let's talk about why bear markets are so dangerous for dividend investors. When the economy slows, companies face pressure. Sales drop, profits shrink, debt becomes harder to manage. And for many firms, the first thing they cut isn't the CEO's bonus, it's your dividend. But here's the good news. Not all companies are created equal. Some have weathered decades of market crashes without missing a single payout. Others actually grow their dividends during recessions. Your job is to find them, and today I'll show you how. Let's start with the cornerstone of bear market defense: resilient sectors. Think about it. When times get tough, do people stop going to the doctor? Do they cancel their electricity bills? No, they prioritize essentials. That's why sectors like healthcare, utilities, and consumer staples are often called recession-resistant. For example, during the 2008 financial crisis, while banks were collapsing, companies like Procter & Gamble kept paying and even raising their dividends. Why? Because people still buy toothpaste, laundry detergent, and diapers, no matter what the economy's doing. But here's the twist. Not every stock in these sectors is a safe bet. You need to dig deeper. Look for companies with low debt, strong cash flow, and a history of dividend growth through multiple recessions. These are your anchors in the storm. Now, let's talk about dividend safety checks. When the market's crashing, you can't afford to be passive. You need to audit your portfolio before the panic hits. Start by asking, how much of a company's earnings are being paid out as dividends? If a firm is using 90% of its profits to fund dividends, that's a red flag. There's no cushion left for a downturn. But if that payout ratio is closer to 50, that company has room to breathe and keep paying you, even if profits dip. Next, look at balance sheets. Companies drowning in debt are ticking time bombs during a bear market. High interest rates? Falling demand? They'll struggle to pay their lenders, let alone you. Focus on businesses with manageable debt and plenty of cash reserves. And finally, don't ignore the CEO's tone. Listen to earnings calls. If management is slashing guidance or waffling on dividend commitments, it might be time to exit. But if they're confidently reaffirming their payout, that's a stock you want to hold or buy more of when others are selling in fear. Here's where most investors go wrong. They panic sell everything during a crash. But the smart move? Double down on quality. Let me explain. When the market crashes, even great companies get thrown out with the bad ones. Their stock prices drop, but their dividends stay intact. This is your chance to buy them at a discount, locking in a higher yield for the long term. For instance, let's say you own a stock paying a 3% dividend. If the price drops 30, that same dividend now represents a 4.3% yield. If the company maintains its payout, you're earning more income and setting yourself up for bigger gains when the market recovers. But, and this is critical, only do this with companies you've already vetted. This isn't the time for speculation. Stick to the bulletproof businesses we talked about earlier. Now let's tackle diversification. I know, it's not the most exciting word. But hear me out. If your entire portfolio is in high-yield energy stocks or tech dividends, you're taking unnecessary risks. During a bear market, you want to spread your bets across sectors that don't move in lockstep. Think healthcare and utilities and consumer staples. Maybe even add a sprinkle of real estate, but only REITs with rock-solid tenants like cell towers or logistics warehouses. And don't forget about dividend ETFs. Funds like the Dividend Aristocrats ETF or low-volatility dividend growers can add instant diversification with one click. Just make sure to check their holdings. Some ETFs are not as defensive as they claim. Here's the secret weapon no one talks about: cash reserves. When the market's crashing, cash isn't trash, it's king. Having dry powder lets you scoop up bargains without selling your existing holdings at a loss. Aim to keep at least 5 to 10% of your portfolio in cash or short-term treasuries. And if you're retired, consider setting aside 2 years' worth of living expenses. This way, you won't be forced to sell stocks at the worst possible time to cover your bills. But here's the pro move. Use a bear market to rebalance. If your defensive stocks have held up well while others crashed, sell a little to lock in gains and reinvest the proceeds into beaten-down quality names. It's like upgrading your portfolio during a fire sale. Let's address the elephant in the room, psychology. Bear markets are emotional. The headlines are screaming, your portfolio is bleeding, and every instinct tells you to do something. But the worst thing you can do? Make impulsive decisions. Selling defenseless stocks at the bottom. Abandoning your strategy. Chasing hot tips. Instead, focus on what you can control. Rebalancing. Reinvesting dividends. Staying patient. Remember, the market always recovers. And if you've built a portfolio of resilient dividend payers, you'll not only survive, you'll come out stronger. So there you have it, your bear market playbook. Protect your dividends by focusing on resilient sectors, auditing your holdings, staying diversified, and keeping cash on hand. But I want to hear from you. What's your go-to strategy when the market crashes? Are you holding steady or buying now? Buying the dip? Let's chat in the comments. If you found this helpful, hit that like button. It tells the algorithm you want more videos like this. And don't forget to subscribe and ring the bell. We'll be diving into exactly which dividend stocks to buy during the next crash, and that video is coming soon. Thanks for watching, and remember, bear markets don't last forever, but smart dividend strategies do. See you next time.